Greetings from MWN.com. Dr. M. Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil, is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. Economic costs of imperfect competition. Imperfect competition is an economic situation where a market does not meet the conditions of a perfectly competitive market. Hence, it is opposite to perfect competition. Perfect competition occurs when there are many sellers. There is easy entry and exiting of firms, products are identical from one seller to another, and sellers are price takers in this market. In contrast, imperfect competition can lead to monopolies, monopolistic competition, and oligopolies. The economic costs of imperfect competition are as follows. 1. Reduced output. Imperfect competitors produce and supply less than they would in a perfectly competitive market. 2. Higher prices. Imperfect competitors charge more than they would in a perfectly competitive market since there are few sellers in imperfect market. 3. Misallocation of resources. Imperfect competition can lead to a misallocation of resources. It may impact underutilization of resources. 4. Dead weight loss. It means the loss of economic welfare occurs when the market equilibrium quantity is not at socially optimum level. Imperfect competition can lead to a dead weight loss in the economy. 5. Market inefficiencies. Imperfect competition can lead to market inefficiencies and market failure. Market inefficiencies exist due to information asymmetries, transaction costs, market psychology, and human emotion. Factor market. Factor market is a market where factors of production are bought and sold. Factors of production, including land, labor, and capital. The firms distribute income to the owners of productive resources in the form of wages, rents, etc. The factors of production along with entrepreneur interact to produce goods and services in an economy. Firms transform inputs, known as factors of production, into output. The inputs are known as the factors of production. It can be classified into two broad categories, namely I. Human resources, labor and human capital including entrepreneurship. E. Capital resources, land, machinery, capital, forests, rivers, etc. Factors of production. Land is a primary factor of production. Land is a free gift of nature. It is permanent or fixed in existence. Sometimes the firm purchase and own land and construct building, or it may be taken for rent. Hence, rent may be the remuneration for land. Labor is the second important factor of production. Labor means people work for monetary gain. Labor may be from top-level employees to lower-level employees. The remuneration paid for labor is wages. Capital is the third factor of production as capital, or it may be termed as physical capital. It refers to the cash or assets such as plant and machinery, tools, raw materials, etc., that are used in further production of goods and services. The remuneration paid for capital is interest. The diagram clearly exhibits the relationship of households and firms. Households or society supply the factors of production to firms, and in turn the firms supply goods and services to households. Consumers' expenditure is the income for the firm, and the firm provides the remuneration to households in the form of wages, rent, interest, and dividends.